The 85-year-old company GNC said it's going to file bankruptcy today. It's going to close 1,200 of its locations. That's 20% of the 5,800 stores. It said 30% of its stores in US and Canada were forced to close due to Corona. So that really affected their earnings. And even though a company can be operating with healthy earnings, healthy cash flow, if just 1 or 2 months it gets no revenue, it just can't pay its bills. Companies live paycheck to paycheck, often like individuals do. I actually bought GNC stock today at 55 cents because I felt the financials looked much better than Hertz. And Hertz has gone up a lot since they filed bankruptcy, so this may be a trend. So I'm just testing it out. And I'll show you my portfolio in a few days if it turns into anything. So to give you a little more color, when a company files Chapter 11 bankruptcy, they're still an active business. A lot of people feel, oh, why would I invest in a company that filed bankruptcy? Chapter 7 means you're liquidating and going out of business. Chapter 11 means you're just reorganizing your business. You're shedding some debt, closing stores. You just have to report to a bankruptcy court and they make decisions as part of your business process, but you're still a viable business. It's possible you'd file Chapter 11 and you end up going into Chapter 7 because it just doesn't work. You can't make a profit. But a lot of times companies do file Chapter 11 and stay in business for a really long time. And there's something called Chapter 22, which is not a real thing. It's just companies that file Chapter 11 twice. Because it's kind of like us individuals, if we run up our credit cards and we have a home we can't afford, we just file bankruptcy and we don't have to pay our debts and we could start fresh. It's not a good way to do things. I would never do that, but people do it and businesses do it. So let's look at GNC's information. This is what I do in a video. I calculate the discounted cash flow model for a business and figure out the intrinsic value for a stock and see if the stock's a buy or a sell. So let's do that with GNC. So GNC's market cap is $49.9 million. And that's the value of the company according to the stock market. And then their stock price is 59 cents. And now we can figure out the shares outstanding because it's the market cap, 50 million, divided by stock price, 59 cents, equals 85 million shares. Now we need to figure out the free cash flows. And this is how you value a company. You estimate the future free cash flows of the business, then discount that number back to today. So let's get their historical free cash flows. And this is what I like about GNC as opposed to Hertz, is they have positive free cash flows. Hertz had negative like $9, $10, $11 billion a year in free cash flow. It's hard to run a business when you're leaking so much cash. Probably in 2020, GNC will not have positive free cash flow, but in the past they did, which makes me feel a little better about their future. And their net income is the profit and loss on the income statement. And this is negative for a bunch of years because the income statement uses accrual accounting, so they might have looked back in prior years and passed through losses in the current years. Where free cash flow is a better indicator of the stability of a company because that's actual cash in and out. There's no accounting going on. And now we'll put the revenue into the model. So now that we have the free cash flow, the net income, and the revenue, it is difficult to value a company with negatives like this, but it's not impossible. It just makes the result maybe a little more variable because you're really relying on your inputs when you do these types of models. The inputs have such a strong relationship to the intrinsic value. So let's look at the capital structure of the company to see how much interest they pay on their debt. They pay $106 million of interest on the debt. And now let's go to the balance sheet to see how much debt they have. And current debt is $180 million. And long-term debt, I'm going to use the 2018 number because it seems like when I use the 2019 number, the interest rate's like 15%, and I don't think that's right. I think it's just a timing issue. Even 9% seems really high for an interest rate, but let's go with that. I can't figure out the effective tax rate because in 2019 they had 4.5 million of income, yet they paid 45 million of income tax. So it's hard to look at 1 year on the income statement, especially with a company with passing through all these losses. So I'm just going to use a standard 20% tax rate. So we discount the interest, the 9.11%, by the 20%, and we get a cost of debt of 7.28%. And let's get the beta. That's the volatility of the stock. And it's probably pretty high. It's 2.23. So the stock moves more than 2 times the market. And now let's get some more information from the balance sheet. Let's get their current assets. Those are assets that can be liquidated into cash within 12 months. And that's 640 million. And let's get their current liabilities. These are liabilities that are due within 12 months. So it's nice to see that current assets are above their current liabilities. The equity, they have a little equity left in the capital structure. They're not negative yet. Although Hertz had a positive equity and they went into bankruptcy. So you can't just look at 1 or 2 numbers. They have over 500 million in retained earnings, and retained earnings is when you sum all the previous net incomes minus the dividend payments. So it looks like they were operating at a profit. Let's look at their operating income, and that's 146 million. That's how much money they generated from their day-to-day business in 2019 after paying their operational expenses, but before paying interest, expense, and taxes. We calculated the weighted average cost of capital. It's a blend of cost of debt and cost of equity, and that's 7.33%. And we're going to use that number to discount the future cash flows. So we estimated future free cash flows for 4 years. Then we did a terminal value, which is all years past year 4. And the reason terminal value is so low is because they're almost 100% debt. So the higher the debt, the more it reduces the terminal value. In my model, that is. So it is a conservative approach if you think about it. And if you discount those numbers back to today's value, you get a sum of $219 million for the company. And if you divide that by 85 million shares, we get an intrinsic stock price of $2.59. Compared to where it's trading at 59 cents, so it's trading at a discount, a 77% discount. So it's a buy according to the model. And I calculate there's almost a 50% chance of default within the next 12 months. So historically, obviously the stock has dropped a lot since they've been struggling and filed bankruptcy, but they were up to almost $50 a share a few years back, and they've dropped a lot, and now they're sitting below $1. So time will tell if the company will be able to renegotiate the terms of its debt, if it will operate at a profit and bring in revenue once coronavirus goes away. So let's look at their financial ratios to get some more information. So the PE is negative because they have negative earnings, so we can't look at PE. The price of sales is 0 because that's price of stock over sales per share. And they're pretty much trading, the price of stock is trading at almost nothing. This indicates investors are willing to pay nothing to get $1 of sales. Sounds like a good deal, right? Usually the lower the price of sales, the better. High price to book because they have so little equity on their book. They have a good current ratio, it's above 1. They could cover their interest payment because their operating profit was 146 million and their interest payment was 106 million. So that's good, they could cover their interest payment. So a lot of companies that go into bankruptcy can't even cover their interest payments and are forced into bankruptcy by their creditors. So let's see what happens. Let me know what you think in the comments. Are you interested in buying GNC stock? I know it's a big risk. It's kind of like gambling, but you never know. It worked with Hertz. Let's see if it works with GNC. Thanks for watching the video.